The latest research coming out about the multifamily sector is not as encouraging as investors would have hoped for, which is impacting both supply forecasts and rent forecasts going forward. And at the same time, there are also some major differences in multifamily operating performance across the United States, with some of the strongest performing metros in the country being some of the most unlikely standouts just a few years ago. So in this video, we'll walk through what the latest research is saying about the multifamily market, why it might take longer to recover than we had initially thought, and what the implications for investors might be over the next few years. So the first thing that multifamily investors need to be aware of is that supply isn't expected to drop off quite as quickly as we had initially thought. According to the Fall 2025 U.S. Multifamily Outlook report from Yardi Matrix, although new multifamily deliveries are expected to decrease from 2024 figures, last month, Yardi actually increased their number of expected annual deliveries over the next few years, up by 6.8% in 2025, 2.5% in 2026, and 12.8% in 2027. And these changes are in large part due to longer construction timelines for projects started in 2023 and 2024, with higher labor and material costs as a result of inflation and uncertainty around interest rate changes, causing projects to be put on pause for multiple months or even years. And as a result of this uptick in forecasted new supply, multifamily rent growth in the US is also projected to stay relatively low over the next few years at just 1.5% in 2025, 1.2% in 2026, and 2% in 2027. Now, once this new supply ends up burning off, Yardi is projecting significantly stronger rent growth starting in 2028 at 3.4%, 3.7%, and 3.8% through 2030. But for multifamily investors who are hoping for rent growth to pick back up in the very near future, these numbers make it much less likely that this will end up happening. Now, the second thing that's worth noting about the multifamily sector today is that some of the weakest performing markets throughout the United States right now are cities that have seen the highest population growth over the last few years. Among the bottom 10 major markets in year-over-year rent growth tracked by Yardi Matrix, rents have fallen by an average of 1.5% this year so far, despite the average population growth in these states coming in at almost 6% since 2020. Some of the most popular cities in the country were included in this list, with Phoenix, Raleigh, and Austin all posting negative year-to-date rent growth, despite statewide population growth in Arizona, North Carolina, and Texas coming in at 5.5%, 5.7%, and 7% respectively over the last 5 years. And on the other hand, among the top 10 strongest rent growth markets this year, statewide population growth has averaged just 1% since 2020, with cities that were heavily out of favor just a few years ago, including New York, Chicago, Kansas City, Cincinnati, and Madison, Wisconsin, all topping this list. And from a pure population growth perspective, this doesn't add up, but in commercial real estate, rent growth ultimately comes down to the dynamic between both demand and supply in a market, and the supply part of the equation is where this story starts to change. The bottom 10 markets for rent growth in the US this year have seen an average of over 9,000 new units delivered in 2025, representing 3.8% of the existing multifamily stock that's currently operating in these markets. However, the top 10 markets for rent growth this year have seen just over 4,500 new units delivered, representing just 2.2% of existing multifamily inventory in these cities. The fastest growing metros in the country from a population perspective have also been the most attractive for developers over the last few years, which has resulted in a huge influx of new deliveries in these cities, which has driven down occupancy rates and rents in these markets. And at the same time, the slowest growing metros from a population perspective have been some of the least attractive places for developers to build new product, which has kept supply low in these markets over the last few years and has kept rent growth strong despite weak population growth. And today, these low growth markets are also seeing some huge announcements when it comes to investments from big name companies, with GE Aerospace planning to invest $113 million into the Cincinnati market, Google planning to build a $10 billion data center campus in Kansas City, and Microsoft planning to increase its AI and data center investment in Wisconsin to over $7 billion over the next few years. And while major metros like Austin and Phoenix are also expected to see continued job growth in the near future, These types of announcements in smaller tertiary markets can make a much bigger impact when it comes to rent growth over time. Now, the last thing I want to talk about in this video is that despite all of these near-term challenges, the long-term outlook for multifamily real estate is still extremely strong. As of October of this year, average rents for multifamily units were $1,786 per month, and average mortgage payments have risen to $2,466 per month before factoring in any ongoing maintenance or upfront repairs that need to be done after a property is purchased. And to quantify this more from an income perspective, for a family that's looking to spend 30% of their pre-tax pay on housing with the additional $680 per month or $8,160 per year required to service a home loan, that family would need to make an additional $27,200 per year in income if they wanted to buy instead of rent. According to Redfin, there were also an estimated 1.44 million home buyers in the US housing market in August of this year, which, with the exception of April of 2020, was the lowest level on record dating back to 2013. And in the second quarter of 2025, the number of renter households in the US increased by 2.6%, while the number of homeowner households in the US dropped by 10 basis points year over year, which was the first decline in this figure we've seen since 2016. It's also worth noting that from a supply perspective, housing starts are still extremely low, coming in at just 10 starts per 1,000 households in October, which is almost 50% less than the long-term average dating back to 1920. And if the supply of single-family homes doesn't increase materially, it's hard to see home prices going down anytime soon in any significant way, especially if we see some additional rate cuts come into play over the next few months. The key takeaway here is that everyone needs a place to live, and with how expensive it's become to own a home in the US today, even despite huge jumps in interest rates over the last few years, it's very likely that we'll continue to see very strong demand for apartments and new multifamily product continuing to be leased up very quickly. And with all of these changes going on in the multifamily sector right now, if this is a part of the industry you're interested in and you want to learn how to analyze potential multifamily investment opportunities, or you want to make sure you have the technical skills you'll need to land a job at a multifamily focused investment, development, or brokerage firm, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the multifamily sector specifically, make sure to hit the like button and let me know, and let me know in the comments what you see happening with multifamily real estate over the next few years. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.